All right. Well, hello and welcome to this evening's webinar, Learn a Better Way to Identify Promising Growth Stocks, led by Wayne Thorp and moderated by John Bykowski. Thank you so much for joining us. We are happy to have you all here. My name is Jennifer Shear, and I'll be your host for tonight. A few things to go over before we begin. I do want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And a handout of the presentation is available under the handout section of your GoToWebinar control panel, located on the right-hand side of the screen. And also, if you a PDF is also available at aaii.com/webinars. And if you have any questions for our speaker during the presentation, please submit them using the question section of your GoToWebinar control panel. Our moderator will select questions submitted and read them aloud for the benefit of all watching the broadcast. And questions that are not selected for the broadcast will be reviewed and addressed afterwards. And if you experience any issues with the audio or video of the webinar, please consult the instructions on how to change your device's settings or consult the GoToWebinar website for support at gotowebinar.com. And just a friendly reminder that this presentation is recorded and a replay of the webinar will be available tomorrow on AAII's YouTube channel, along with links to this presentation's handouts and any other resources that we discuss. And just for new viewers, we like to give a little bit of background of our organization. So the American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And so with that, I'd like to hand over the presentation to John.
Thank you very much, Jenna. It's a pleasure to be here, and I'd like to welcome everybody to our special presentation tonight. And my job is actually very easy. My job is to actually introduce our speaker. And Wayne Thorp has been at the association for is it over 25 years now, Wayne, or is it approaching
Yes,
that?
it has. Yep,
And,
25 years.
It's a man that almost needs no introduction, but he has. I've had the privilege of working with Wayne, and you as members have hopefully had the privilege of enjoying his work. Wayne is a vice president here, and he's in charge of our research. And his input has been helped us develop Stock Investor Pro. It's helped us develop the Stock Superstars report. He's worked on A+ Investor. He's instilled a lot of his personal research and knowledge in the markets, and he's been really striving to make tools that are accessible to individual investors and help them reach their wealth and their dreams. So with that, I'd like to welcome Wayne.
Thank you, John. Pleasure joining everyone this evening, and I just want to say a personal thank you for all of your assistance over the last 25 years, and especially over these last year or so as we've been working on this growth investing product. So, pleasure to be here.
Looking forward to hearing it. And are you going to have some? I think Jenna, perhaps we might need to actually upload the slide deck. So I think we mentioned that it's available for download. So if anybody's listening in and looking for the slide deck, Jenna will make that download available shortly. I think hopefully that'll be up and coming. But Wayne, I'm excited about the presentation. I know time is short here. Why don't you go ahead and get us started? So the title of our topic of our tonight sounds simple, but basically, when it comes down to it, can you give us a big breakdown of what exactly growth investing is?
Sure. Growth investing is an investment style and strategy focused on seeking out companies growing faster than the market or even a firm's industry. The key consideration is the expansion of either top-line sales or bottom-line growth. Growth investing is concerned with capital appreciation. Growth companies can pay dividends, but they usually aren't meaningful and they tend to be incidental, as most robust growth companies are actually reinvesting their excess cash instead of paying them out as dividends. Therefore, growth investing isn't for those who are looking for income generation. Instead, the investment returns for most growth strategies come from capital gains or share price increases. Now, in contrast, value investing focuses on seeking out companies that can be purchased at a discount to their valuation, which is typically measured through cash flow, earnings, dividends, or even assets. Often these value companies are more mature than growth companies and are more likely to pay meaningful dividends.
Now, historically, growth investing, there's perhaps different camps, and as you noted, and How has growth investing done as an approach relative to other approaches?
Well, it really depends on the time period that you look at. Over some periods, growth will outperform other strategies such as values and vice versa. If you look at return data going back to the 1920s, which is really when meaningful stock data really originates, growth strategies have underperformed value-oriented approaches over the last 100 years or so. However, there are notable exceptions when growth has outperformed value approaches, such as over the last 10 to 15 years. But then you've seen a flip over the last 12 months where value has significantly outperformed growth. However, I feel that there's always seems to be some compelling value and growth investment opportunities throughout the market cycle. Uh, so, because of that, I really think it's more important that investors find a sound approach that resonates with them and that they can follow it in a disciplined manner.
Well, like you said, I mean, growth investing has come on really strong last 10 years. One thinks back to the dot-com era as well. So why focus on growth investing now?
What really initially led me down this path of trying to develop a growth oriented stock selection approach was really who and not what. And the who are AI members. We continuously survey our members. And one of the questions we ask periodically is what is their preferred investment style? And nearly half of our members have been stating that growth is their preferred strategy. So our members are very much interested in growth investing. So, looking at the needs and the wants of our members, we then looked at our sort of our offerings, and we looked at our AAI model portfolio stable, specifically the AAI Shadow Stock Portfolio, Stock Supercharge Report, Dividend Investing, and VMQ. And really none of those portfolios have what you'd consider to be a sort of a quote unquote pure growth component to them. So, we have a need and an interest amongst our members, and we had it was seemingly a hole in our offerings. So, this led us down the path then to start looking for a solution and a strategy to maybe fill that. But, one of the problems I face though, and is what we discussed at the beginning, is that there are periods of time, especially over very long periods of time, when growth has tended to underperform value. So the question I really then asked, are most growth investing strategies, doing it wrong? And if so, can we come up with a growth investment approach that, hopefully, and at least attempts to do it right? Uh, you know, most growth approaches seek out high valuation stocks or those that have high or relatively high or absolute or relative growth levels. From an academic standpoint, dating back to Fama French in the early 1990s, and more recently with Partha Monarham, the growth and value universes are often based strictly on the price to book ratio. Low price to book stocks are considered the value universe, and high price to book stocks are considered growth. But there really aren't any type of qualifying factors that are used. Now, stocks with high valuations, which are measured by price to book, price to earnings, or whatever, they tend to carry high expectations of future growth. And that's why investors are willing to pay such high multiples, because there's the expectation that they're going to continue to grow at these high levels. And that's also why then if you're screening for companies with high growth rates, you tend to find stocks that have dizzyingly high multiples or valuations. It's really tempting as an investor to seek out high growth stocks, but the problem is the approach doesn't necessarily generate the best stock performance. And actually, I have a slide here that really bears this out. And this was sort of the beginning of some of the research that I was doing on this approach. Just to verify, you can see the slide, John?
I do, but is the bottom of the slide slightly cut off?
I
The date reference?
It's showing on my screen.
Okay, well then,
But so yeah, so what we did here was I started by looking at a very simple metric, 5-year sales growth. And what I did is I took the universe of U.S. listed stocks and looking at the percentile rankings of their 5-year sales growth, I broke the universe into quintiles or 20% bands. And on an annual basis, I looked at the stocks that were in each of those 5 quintiles. and basically on an annual basis rebalanced and calculated the cumulative performance of those bands. And as you can see here on this slide, between 1998 and the end of May 2022, the stocks that ranked in the top 20%, that for the companies with the highest sales growth, performed worse than those that even had the weakest sales growth. So the data shows that companies in the middle 60% of the stock universe perform significantly better based on their 5-year sales growth compared to those at the extreme ends. And this corresponds with the investment philosophy of John Neff, who's actually one of my favorite superstar investors. And when he was managing the Vanguard Magellan Fund, Neff and his team looked for companies that were generating reasonable but sustainable levels of growth. And Neff felt that these companies could maintain this growth longer and were less apt to disappointment. And this is key because, as I alluded to earlier, it's the expectations that are priced into high valuation stocks. As expectations are revised, perhaps because of slowing growth, these valuations tend to adjust very quickly and significantly, typically to the downside. This is often referred to as reversion to the mean. But if you invest in companies that can generate solid growth year in and year out without much change, they're much less likely to disappoint and see their stock prices punished because of that.
That's interesting that you point that out. I remember also we did a study. We published a journal article as well. We looked not only at historical sales growth like you did here. We thought, well, maybe the forward earnings are a good predictor of future performance. But I think we found a similar situation where the companies that had the highest expected rates of earnings growth went on to disappoint going forward. I mean, I know that when you talk about growth investing, sometimes it's called buy high, sell higher, or the greater fool theory, where I'll be willing to pay more for a stock's price as long as I can find someone else who will buy it from me. But so how did you overcome the whole? I mean, I remember you being a little bit frustrated by this observation. How did you come across? How did you get past this situation where the highest growth companies went on to underperform the mid-grade growth firms?
Yeah, this is one of the things I really struggled this for a long time, and I don't think it's revolutionary, but I have to say that I haven't found any other services out there that really did this. But based on this, the backtesting results that we showed here, I looked at AAII has the A+ growth grade, and as it was initially formulated, the growth grade awarded highest grades to companies that had the highest growth rates. And then after looking at this backtesting result, they realized, okay, there could be a fundamental flaw with this growth grade. So what I did was, to overcome this high growth issue that the backtesting revealed, I started playing around and I created a composite that placed greater weight on growth that was in that quote unquote sweet spot range of the middle 60% of the stock universe. But then I also looked at the factors that many growth-oriented mutual funds and ETFs use to select stocks, and found some additional themes beyond long-term growth, and that included consistency of growth as well as profitability. So what I did is I tested companies based on their year-over-year sales growth and their ability to generate positive cash from operations on an annual basis. And what I discovered, and I don't think it's revolutionary, but it actually, in hindsight, it makes perfect sense from a sort of a logical, common sense standpoint, is that companies that can grow their revenue yearly, as well as generate positive cash flows year after year, outperform those that don't. And actually have some slides here that shows this as well.
I'm getting some notes from our viewers that the bottom of the screen is slightly cut off. So what we're showing here is a time period, and it goes from 1998, and the end point is 2022. So
is that any better?
Oh, that is better. Okay, I can see the bottom now.
Interesting. It's the clean was too clean. It was cutting things off. So apologize for that. So I also then tested for looking at companies that basically, looked at companies and the number of years that they had a year-over-year sales increase over the last 5 years. And what I found was, the stocks that have 5 out of 5 years in sales increases, this is that top dark blue line, and then moving down, you've got 4 out of 5, 3, 2, 1, and companies that have no annual increases over the last 5 years. And so you can see, very, very clearly that the market will reward companies that are able to grow their sales year over year.
And you're just to confirm here, is this a, because I have a question here, this is a strictly sales growth you're looking at here. Now
Yes.
this is top line sales growth. You're ignoring bottom line EPS growth, and you're looking at the overall growth rate, or are you looking at other factors beyond simply growth?
Strictly whether or not, so we looked over a 5-year period. If a company, doesn't matter if it was, a 0.1% or 1,000% increase in sales. If a company boosted its sales from one year to the next, it was basically awarded 1 point. And if it was able to do that over the 5-year period, it got 5 points. So it's basically the stocks that had 5 points, this is their performance on the top. The stocks that weren't able to increase their sales any of the years over that 5-year period got 0 points, and those are their performance is the green line on the very bottom.
Okay, thank you. And when you say it's a composite, does it have anything besides that consistency of sales growth in this chart?
No, actually, it's probably a misnomer. The composite was more on the long-term sales growth. This was just,
Gotcha.
just looking at,
So just to
and then,
clarify.
yep. And then did the same thing looking at annual cash from operations and companies that were able to generate positive cash from operations. If a company was able to generate positive annual cash flow for each of the last 5 years, it was received 5 points. If it wasn't able to generate positive cash from operations in any of the last 5 years, it got 0 points. And as we saw with the year-over-year sales growth, companies that were able to generate positive cash from operations, 5 out of 5, had a significantly better performance than those that had 4, 3, 2, or 1.
And roughly speaking, so these are, again, a question here. These are roughly equally divided groups then. So you would take a look at, you would exclude any companies that didn't have, in the case of sales growth, the previous one, all 5 years of sales, you'd exclude them.
Correct.
Or they wouldn't get the points, the full 5 points. And so you're basically taking, if it's let's say it's 100 companies, just making the number up. These are quintiles, is that correct?
These are not exact quintiles. I'm trying to think here. Let's see. So the score of 100. I'm trying to remember if I re-ranked this or not.
So they're roughly equal groups, though. Divided
Yes, yes, I believe they were. Yes.
Okay.
Yeah.
Thank you.
Mm-hmm. So we had this initial A+ growth grade that basically rewarded highest grades on companies that were able to grow their sales, earnings, and cash flow the highest. But then we found, based on this, I found in this back testing that necessarily isn't the best way to go. So instead, I created a revised growth grade that places greater value on companies that are exhibiting consistent, strong, but sustainable growth, as well as those that are generating positive cash flows year in and year out. And the result then was a new growth grade that, based on our back testing, generated better performance across each higher grade. And so we see here this on slide 5. So those companies that were in the quote unquote A group, which was, we took each of the 5 composites, each of the 3 values, then we did create a percentile ranking for each of those 3 elements, added those together, and then re-rank them. So that was, you're getting equal distributions across the A, B, C, D, and F grades. And again, rebalance them annually. And we can see here then that the dark yellow line at the top were those companies that had an A grade, all the way down then to those that had the F grade, which is the dark blue line at the bottom. And so you can see that, A outperformed B, outperformed C, outperformed D, outperformed F. So that was the sort of the start. You can read more actually about this new growth grade. I wrote an article in the October issue of the AAII journal. But sort of the first step in the process over the last year or so was seeing if we come up with a better growth grade that could at least allow us to start being able to evaluate stocks and their growth characteristics.
So you said you did an article about this in the journal.
Mm-hmm.
So in terms of, you said, was this we prior to this we actually had a growth rate calculation on our website for A plus investor subscribers.
That
So
is
how
correct.
can members get access to this revised growth grade?
So with an A plus investing or an AAII platinum subscription, you have access to this growth grade, and you can analyze individual companies using the stock evaluators that are part of A plus investing, or using the stock grade screener to isolate companies with the highest growth grades, as well as screen on the other 4 A plus stock grades, which cover momentum, estimate revisions, value, and quality. So for example, looking at the growth area, so the growth data that underlies Alphabet, which is Google, from the growth evaluator, you can see here that Google has a 5-year sales growth rate of 23.3%. Its sector median is 9.2. But with using that composite where, you unfortunately I cut off the text, so I don't remember what percentile that was in. But, it has been, I'm assuming it probably is a relatively high percentile given its growth, and that's why its metric score is kind of low at 51. But then it also has been able to generate year-over-year sales increases for each of the last 5 years, as well as positive annual cash from operations from each of the last 5 years. And its overall growth score then is, I cut it off, but I do remember it was an 82, which is just above the cutoff for the A grade for the growth grades. But this data is available on the stock evaluators, but then you can also use the A plus investor stock grade screener, where you can screen for companies on any of the 5 A plus stock grades, but in this case specifically growth. So what I actually did was I did a screen for companies that have an A growth, A grade of a growth grade of A. Actually looked for companies that were higher priced, more pricier, with the value grade of D and F, momentum of C or better grades, estimate revisions also of C or better, but also looking for high quality companies of A. So that gave us 134 companies as of, I think, the close of the day before yesterday.
Thank you.
So yes,
Yeah,
as A
I think
plus or
in terms of Google, I'm sorry, Google had a 82nd percentile was its number before.
okay.
I think you were asking about that. Sorry, I cut you off there.
No, that's okay. So that would have given it I think a 40. So it would have been a lower value, lower weighting on the composite scale because it had it was in that top quintile of sales growth. So these are a couple ways that A plus or platinum subscribers can use this new revised growth grade.
Well, that's interesting. So I know that it sounds like you didn't stop there though, because you were talking about how you know, if you're going to do a growth approach, the growth grade is a good first step at identifying companies that have had consistent earnings growth. I'm sorry, in this case, sales growth, are consistently cash flow positive, and are able to increase their sales every year. But then I know that you had done some research on other approaches to see, is there a way to further measure if companies are doing something today on a fundamental basis that is going to be perhaps predictive of keeping that growth more stable going forward. Can you tell us a little bit about that?
Absolutely. So, I was very pleased with the results that I got for the growth grade, but yeah, I certainly didn't feel that was enough meat on the bone to really try to build a strategy around. So I was definitely curious to see if there was a way to evaluate more of the quality of a company's growth and identify the characteristics that could lead it to persistent future growth. So, following AAII's belief in evidence-based investing, I look for ways to mitigate the risk of investing in these so-called, quote unquote, glamour stocks. And that led me to the research of Partha Monarham, and I apologize if I'm mispronouncing his name, and his G-score. Now, Monarham is a professor in the accounting department of the University of Toronto's Rotman School of Management. And in 2004, he published a paper that extended the analysis done by Joseph Piotrowski, whose F-score, who AAII was really one of the first organizations really to latch on to the F-score, but whose F-score applies fundamental analysis to filter value or low price to book stocks into winners and loser categories. Now, Monarham developed a G-score, which is an 8-factor model using financial statement analysis. But he focused on these quote unquote glamour or high price to book value stocks using 3 types of signals. The first being growth signals based on profitability, the second, stability or variability signals, and then lastly, signals related to accounting conservatism. And his research and backtesting showed that high G-score stocks outperform low G-score stocks. Now, we also tested our own variation of the G-score, but was a 7-factor model due to the lack of availability of advertising expense. One of the things he measures is he looks at the, as John alluded to, Monarham looks at the company's spending in terms of research and development, capital expenditures, and advertising expenses. And he compares that level of spending, relative to a company's assets, and compares it to other companies in its industry. And companies that are spending a larger percentage of their total asset base on those different expenditures are awarded points in the G-score level. But we didn't. Our data provider, the data source we were using, our Stock Investor Pro software, doesn't have advertising expense, so we weren't able to do that testing. But our 7-factor G-score model, even with just the 7, showed that at every level a higher G-score outperformed lower levels, and at the highest level there was a significant level of outperformance. So that was sort of took the next step, was trying to again sort of evaluate the quality of a company's growth and see if that was a good overlay. And Monarham, you looked at high price to book stocks, but when we started doing them, the path, I'll talk about this a little bit later, was we actually looked at the top 20% as far as the growth grade, and we used that as a proxy for price to book. Because it's looking at, it's not just price to book, which without any additional filters. So yes, but we did then move on, and we're looking at this G-score.
So this is actually research you had done or kind of put together this summer. So in terms of taking it to the next step, how can investors take advantage of this combination of the growth score and this G-score?
Well, as we continued down the path and kept doing additional analysis, and we're getting some promising results, we actually put that into and building an actual investment strategy, the AAII growth investing approach. And one of the tools that will be corresponding that when we launch it, hopefully next week, will be our new growth analyzer tool, which will be part of growth investing. And with that tool, you can enter in a ticker, and you can look at the intersection of a company's G-score and its growth grade. So in this example, we're looking at CSG Systems International. This company primarily provides business support system software and services to the telecom industry. But we can see here that as of yesterday's close, it had a growth grade of 90, which is an A or very strong. And it also had a G-score of 7, which indicates it has highest growth potential on a 8. Actually, yes, I have 7 and 8. Sorry, had a might 7 and 8 on the G-score scale indicate highest growth potential. So sorry, got in my head right there. But you can see then below these dials we have the G-score factor tests. And we've broken down the G-score into those three elements of profitability and cash flow, business variability, and accounting conservatism. And you can see the different elements that exist under each of those. And if a company meets that test, it gets a check mark and it gets a point. And if it didn't, it gets an X, so it doesn't get a point. And I'm almost positive that probably CSG Systems International does not explicitly report advertising expenses on its financials, which was actually, just an aside, something that I found very interesting, is very few companies actually report that. And doing some analysis of that, a lot of companies consider that to be almost a trade secret. And they don't want their competition to know how much they're spending on advertising, so they won't explicitly report it on their financials. But with this, then you can click on these individual links and it'll give you a background as far as what return on assets is, what cash flow ROA is, give you an explanation of that test, as well as the data specific to whatever company you're looking at.
So in terms of members gaining access to this kind of evaluation, what's the way to do that?
So this will be the AAII Growth Investing is a new newsletter that will be launching again probably sometime next week. Now, if you are a platinum subscriber, one of the benefits of being a platinum subscriber is you get access to all of the AAII portfolio services. So if you're a platinum subscriber, you basically have to do nothing. Once this actually goes live, you'll probably get an email alerting you to that fact. But as a platinum subscriber, there's nothing you can do, nothing you will need to do. If you're attending today's webinar, and you will get an email that will provide you an exclusive pre-release access to the Growth Investing website when it goes live. Again, right now, tentatively, we're aiming to launch a week from today. Otherwise, then either as a Growth Investing subscriber or a Platinum subscriber, that would be the way to access this once we go live.
So what sets the growth investing approach apart from other growth-oriented approaches?
Well, I personally, I think that maybe we're actually now doing AI growth investing is taking the quote unquote right approach to growth investing. Because again, I've never found anything that really takes the approach that we did, where you're rewarding companies that aren't growing the fastest, but rewarding companies that are growing at a rate that's going to be more sustainable over the long term. So I think that's one thing that I think really differentiates it. But the growth investing approach is looking for stocks at that intersection of high growth grades and high G scores. And so, as of, I think, again, as of the close on the 17th, here's a sampling of about 10 or so companies that had a growth grade of A, a G score of 7 if the company doesn't report advertising expenses, or 8. And so, I think it's a unique combination of the G score, which can allow to evaluate sort of the quality and the potential persistence of growth going forward, as well as a growth grade that again takes, I think, a novel approach to weighting the growth prospects of at least the historical growth capabilities of a company, looking at a function of long-term sales growth, year-over-year sales increases, and cash flow generation.
Just so I'm clear here. So with what we're doing here then is you're looking at those three key components for consistency of growth. You're then
Yes.
looking at all of those factors that if these companies are doing these things today, spending on advertising, R&D, are showing profitability, less variability than others. That's part of, I think, the G score as well.
Yes.
That intersection. Now, when you get into factor investing, I know there are other factors such as quality. Does any of that come into play in terms of the
Yes.
filtering?
So the sort of the cornerstone elements of the growth investing strategy is the G score and the growth grade. But also because quality, definitely to be able to toss out potential sort of duds of your portfolio. We're also overlaying the A+ quality grade, and a company has to have a quality grade of B or better in order to be considered for the growth investing strategy.
And I know you. It's funny. I know you mentioned the F score before, because I think the F score is one of the components of the quality grade, if I'm not mistaken.
You are
So,
correct. Yes,
a
it is.
company like Google, I think, actually has a very high F score as well as a G score. So it's typically pretty high quality. It's so things like accruals and those things are positive. So it has its risk of bankruptcy is low. It's doing all
Mm-hmm.
the right things. It's debt levels are reasonable and whatnot. Uh, when it came to looking at, so a couple of questions are coming through here. Hope you don't mind me answering them,
No.
asking them now. Um, so the data for this, where did the data come when you're doing this analysis?
So, I mean, this is raw data that we use. It's the same data feed that we use for our Stock Investor Pro software. It's just more of a raw feed. So we're able to do things on the back end analysis that is now separate from Stock Investor. We have a great small, dedicated, and highly talented group of developers that can take sort of our raw feed and start analyzing this data separate from our data processes for Stock Investor Pro. So it's the same high quality Refinitiv data that we use for Stock Investor Pro, but this is now data analysis that's sort of independent of the Stock Investor data feed.
And when you look at things like R&D or even advertising spending, I mean, you're going to find that that's probably very specific to certain industries.
Yes.
My guess is that a company that's making fasteners for the auto manufacturer probably doesn't have a big advertising budget, but Best Buy may.
Correct.
So, I mean, is there a risk then that if you're trying to give companies more score or higher score for some of these things, you're doing some industry concentrations, or are you adjusting for industries anyway?
I mean, that's an excellent point. We are not making any adjustments for industries. So
Are we
yes,
doing some comparisons against industries though? I thought.
okay. Yes, from that standpoint, you are correct. All of the tests. Yes, thank you, John. All of the tests that we're conducting for the G score are comparing a company's value against its industry peers. So yes, there is a comparison at the industry level. So for example, we're looking at a company, the percentage of, in this case, the percentage of advertising that Google is spending relative. So the advertising expenses the company is expending relative to its asset base, that creates what is called an advertising intensity ratio. We then take those advertising intensity ratios for all the companies in a specific industry, come up with a median value, and in order for a company to get a point on the advertising intensity scale, its own advertising intensity value has to be higher than the industry median. So
So in
yes,
case of Alphabet's in the online services industry, so it's to get a point that has to be spending more than the typical online services thing. And so
that is
you
correct.
basically for the G score factors where industry consideration is key, you're doing that kind of comparison.
Yes.
Yes,
Yes, because most of the ratios that we're using, definitely, will differ by industry, like most ratios do. So yes, we are doing that industry comparison.
Thank you. Is there anything in terms of risk or risk comparisons or risk index that you took a look at? Are these stocks riskier than others, or do you know how they're going to perform in terms of certain market environments?
Well, as just an example, so here this slide that we have up is the current list of ideas. These stocks aren't, well, we haven't started buying the portfolio yet.
Okay.
And there's no guarantee that these stocks will end up in the actual portfolio when we
So
actually start
members are
making those
asking, what is
trades.
the risk index?
So the risk index looks at the monthly returns for a stock over the last 36 months. And then we calculate a standard deviation figure. So basically it looks at the variability of monthly returns, price returns over the last 36 months. And it compares that against an overall market index. In this case, it's the IVV, the S&P 500 index ETF from iShares.
Okay.
So basically, this is a measure of the monthly variability of price returns relative to the S&P 500. So in this case, a 1.23 means that SERI over the last 36 months, its monthly returns are roughly 23% more variable than that of the S&P 500. You look at Sleep Number, it is actually over 250% or 267% more variable than the S&P 500. So you can see, based on looking at individual companies, there is some variability when you consider monthly returns relative to the S&P 500. Now the key is whether or not these companies, how closely correlated they are, or how closely they move together. Because if these stocks don't move relatively in tandem, then these high risk index numbers don't mean as much, because as you start adding stocks into a portfolio that have high returns but have a low, don't move in tandem that closely, then that's where you really are able to generate some significant diversification benefits.
Okay, thank you. And then, like you said, it's the covariance and that kind of stuff will come into play.
Well, we won't talk about
why don't
that.
you continue on? Why don't you continue on with your presentation? Sorry, I keep making you stop.
Oh no, that was actually I think that sort of concluded that section. It's I think I know one thing. One of the promises of attending tonight is there a term that I wasn't overly familiar with, but have become acutely familiar with as I've been doing this analysis, is the whole concept of secular growth companies. And in effect, we feel that the companies that meet the AI growth investing approach fall more into this category of secular growth companies versus cyclical growth. Now, cyclical growth is highly correlated with the economic cycle. So as a result, industries that are driven by cyclical growth tend to deliver positive returns during expanding economies, but then will tend to reverse and do more poorly during a downturn. Automobiles are sort of a classic example. If you look at the Great Recession in 2008, the economy and consumers went through a pretty rough time of it in 2007, 2008. And so, during that period, automobile sales basically fell off a cliff. But as the economy rebounded, people felt more confident in their financial situation. They might have been putting off buying a new car during that period of uncertainty. Coming out of the Great Recession of 2008, automobile sales went through the roof. So if you looked at the growth, if you looked at a typical automobile company during this period, they probably had sales growth that was well above average for a lot of companies. But were they truly a growth company? They were experienced very solid and significant cyclical growth. But these are companies, again, that as either that demand dried up, people bought their new cars, or inevitably when the next downturn in the economy takes place, automobile sales are tied very closely to that of the overall economy. In contrast, secular growth occurs when something fundamentally changes within a sector or an industry that creates a wave of new demand. Secular growth rates can be materially higher than cyclical growth rates, as secular growth depends on changes in customer behavior rather than changes to GDP. Arguably one of the great secular growth stories of the 21st century has probably been the rise of e-commerce. Online sales have gained more market shares from traditional retailers over the last 20 years or so. And this is a secular trend that has transformed how people shop. I would say, probably 80% of the shopping I do these days is on Amazon. Amazon completely changed the way that people shop. You get, you drive past people's houses, and especially around the holidays, you see a pile of Amazon boxes by a front door. People are less and less are going into the more quote unquote brick and mortar stores. Now, it's important to note that secular growth is not immune to the hazards of a recession, although some trends are robust enough to withstand even the worst downturns. For example, the market share of e-commerce did dip briefly during the Great Recession of 2008, but it resumed its steady climb shortly after that. Some of today's probably higher profile secular growth companies include Amazon, Alphabet, which is the parent company of Google, and Apple. Really, when you think about it, a secular growth company is offering a product or service that either companies or consumers are going to buy basically no matter what happens with the economy. Obviously, Apple is, Apple's devices, its phones, its watches, even now, it's so highly correlated, tied into the app store and everything like that. Yes, inevitably, if we are entering a recession, its demand for its products might dip somewhat, but Apple's not really going anywhere. It has created a product and a service that consumers will buy and continue to buy. Same thing with Google. Google is probably considered more to be an ad store these days, but it's able to generate its significant ad revenue because it is basically the search engine that's out there. It's obviously dipped into to other areas these days, but I don't know. I know I could tell you the last time I did an internet search that wasn't Google. So again, you just look at it from companies that offer a product or service that basically no matter what's going on in the economy, chances are very good that the demand will be sufficient enough to keep boosting its sales year after year.
Sorry, I've been busily trying to answer some questions here.
No worries.
Taking us down to the next level, and I guess a couple of questions I guess have come up, and maybe it's the right time to answer them. So, the question, one of the critical questions that I keep getting is, how does a member get to the growth grade versus when does one get the growth grade and the G score? What's the connection between a platinum membership, A+ investor, and the levels of information and research that's available to you?
Sure. So we'll sort of start off with the growth grade. So the growth grade is part of A+ investing service, which is a premium service provided by AAII. You can either subscribe exclusively to A+ investing, or you can have access to it as part of a AAII Platinum subscription. And AAII Platinum basically bundles A+ Investor, which is AAII's online investment discovery, analysis, and tracking tool, as well as our premium portfolios, Stock Superstars Report, BMQ stocks, dividend investing, and then very soon AI growth investing. So you get access to the growth grades via either A+ or Platinum. Now the G score at this point is not available to anyone, but it will be because as part of AI growth investing, it will be found on the various tables as well as the growth analyzer that accompanies a growth investing subscription. So again, there's two ways you can access this. Would be to subscribe exclusively to AI growth investing, or if you're a platinum subscriber, that will be part of the bundle that's included in Platinum, AI Platinum. So you have access to the growth analyzer, which will include the G score that way as well.
Thank you, and continue on, Wayne. You're on a roll here.
I'm just trying to, we anticipated, some of the questions that we might have been getting. I'm sure inevitably is, get the question is, why would I use growth investing as part of my portfolio? And whether AI growth investing is right for you really depends on your investment approach, which is tied to your risk tolerances, your time horizon, et cetera. Then, ultimately, then, whether or not you have a need or for a desire for growth stocks in your portfolio. I consider myself more of a value investor. I strongly believe in value investing, but I also firmly, I've spent a better part of the last year developing this strategy, and I do have a lot of confidence in it. But so, even though I consider myself probably more of a value investor, if you look at my overall portfolio, I still have growth elements in it as well. So even if you consider yourself a value investor who looks for stock bargains, trading for pennies on the dollar relative to earnings, sales, or book value, chances are you probably still have some room for a level of growth investment. And that's because investing across styles in this case, growth versus value, is one way to create a diversified portfolio. Now, secondly, investment styles fall into and out of favor. And I can't sit here and say with certainty whether growth is going to outperform value this year or vice versa. I talked about earlier is, I don't focus on is value in favor or is growth in favor. What I look for is a strategy that I have confidence in that inevitably will allow me to uncover opportunities based on that strategy. So just because the market, if you look at a growth ETF or a growth index or a value growth index or value index, if that index might be falling, there's still chances are there's opportunities if you have a well-reasoned and sound investment approach that will allow you to uncover opportunities in either a value style or a growth style. Pardon me. So, I'm not overly concerned. Obviously it hasn't been a good year for growth, but I'm confident in the overall approach that will allow me and allow others who subscribe to be able to uncover, promising growth opportunities.
Are there anything else you'd want to have our listeners here take away before we close up for the night?
I think, honestly, I've been in the business long enough and I'm getting old enough now where, it's very rare for me to have aha moments. But, I have to admit that I had an aha moment when I did that back testing and found, that investing in the highest growth or the best growth isn't going to necessarily give you the best investment returns. So I think that's one thing, even if you're not going to follow the growth investing approach, I think that is something to keep in mind that if you are screening for growth in a company, it's not going to be the highest or the best. It's going to be a growth rate that a company is able to sustain over the long term. And doesn't matter again what type of investor you are. I think having a long-term mindset is very important. We all invest for different reasons. Whether it's you're looking to retire, you want to buy a new house, you want to send the kids to college, etc. Now, if you need money in the next 3 to 5 years, I personally believe you probably shouldn't have that money in the market. You should probably have it in a more, risk-free rate, CDs, something like that. This is going to protect you from any near-term market downturns that could really upend your plans. But otherwise, looking years into the future is helpful, not just months or quarters. I think that's one detriment, and that's one advantage that individual investors have is, we can have a much longer perspective than a money manager. Basically, they're judged by quarters or probably at best a year. So having that longer term mindset especially when it comes to investing in high valuation stocks, having a longer term holding period really lessens the risk associated with high valuation stocks. And actually, I'm going to show you a slide that actually was another one of the aha moments that I've had over the last year or so. And this shows you, this is data that is from Boston Consulting Group and Morgan Stanley. But basically, over the period from 1990 through 2009, and you got lines all over the place. Sorry about that. This did not. But what they did is they looked at the sources of total shareholder return of top quartile performers. And they looked at that over a variety of holding periods, 1, 3, 5, and 10 years. And they broke down the sources of total shareholder return by free cash.
Are you sharing, Wayne, by any chance?
Oh, maybe I'm not. I'm sorry. I think I did. Apologies. Is it back up now?
It's back up.
Sorry. Yes. So, this data here is from Boston Consulting Group and Morgan Stanley. But looking at 1, 3, 5, and 10-year holding periods, they looked at the sources of total shareholder returns. And this is looking at S&P 500 companies from 1990 through 2009. And as you can see, the thing that really stuck out for me is the longer the time period you're looking at, the price multiple, which is the yellow, that as a source of total shareholder return drops significantly. So I take this to mean, obviously, there is a risk. One of the risks of growth investing is you buy a high valuation stock. There's a lot of risk with that because, again, as I mentioned earlier, this valuation is being driven primarily by the expectations of the market. And if a company misses those expectations, or the expectations are downwardly adjusted, inevitably this valuation is going to fall because the share price takes a significant haircut. But the longer the time period you're looking at, so the longer the holding period you have, the impact of the price of the multiple, whether it's, I'm assuming price, PE, price to book, whatever, really drops off. And over the long term, it's elements of sales and profitability, which are key components of the AAII growth investment strategy. Over the longer term, sales and profits are what are going to be the primary drivers of total shareholder return. So I think that's, those are probably the things that, I would really want people to take away from this. Again, whether or not they use or subscribe to growth investing, just understand that, when it comes to looking for growth in companies, the best isn't the best when it comes to returns, and that the longer your holding period, really it's sales and profits that are going to be driving total returns over the longer period of time. So I think that those are probably the two biggest things that I would hope people could to take away from attending today's webinar.
And obviously, this sounds like a bottom-up approach. I mean, to the extent that you're running these filters, you're finding stocks that look interesting, and then you're putting together a portfolio. So,
Yes.
when it comes to, everyone loves a free lunch, but when it comes to free lunches in the investment community, diversification is one of them. How many stocks do you anticipate holding in the growth investor letter, and is there a minimum that number of stocks people should consider when they're putting together a portfolio?
So right now we're going to be aiming for, when we're fully invested, to have 20 stocks in the portfolio. It may take us a little while to get fully invested, but the goal is once we're fully invested to have 20 stocks. Realistically, when it comes from when you look at diversification, the more stocks you own, assuming that they're not perfectly correlated, which again is probably a higher level discussion than we want to get into here. But basically, if you're investing in stocks that don't move exactly like each other and have similar rates of return, putting them into a portfolio is going to give you a portfolio that actually is less risky, less volatile over time. So the more stocks you invest in, assuming that they're not perfectly correlated, the greater the diversification benefits. So I would say, with a 20 stock portfolio, I would say realistically, at least 10 would give you a sufficient diversification. But again, you want to, looking at, in this case, since they are using sort of the same style, you'd want to be diversifying across more sectors and industries.
Makes sense. And I've always found, and I think they found that through studies, very often it's you need that broader base, because chances are you're going to have a couple of losers. Hopefully you'll be selling them quickly. You'll have the majority of stocks probably just simply follow the market. You can have a couple of those big winners that really help generate those returns for you long term. I've had a member here who's asking, okay, the shadow stocks, they've had a pretty good long-term track record. Growth stocks have done well lately. When it comes to benchmarking your index or your expectation going forward, do you have a target benchmark for this portfolio, and is there a target return or volatility you're looking for?
So we will be using the S&P 500 index will be our bogey for this portfolio. As a proxy, we'll be using the IVV, which is the iShares, I think, core S&P 500 ETF. So that will be our benchmark. And so the goal is to outperform that benchmark over the long term. So that is our benchmark, and that's the return goal for the portfolio.
A couple of questions on back testing. So uh, just to confirm, we're using Refinitiv as our data source.
That's
And
correct.
the other, I think, question they kind of came up with is, so using as reported data. So when you're looking back at 1999 or 98, whenever you're looking sort of start, you were looking at the data that was available at that point in time. You're
And
not
the
looking
stock universe that existed at that point in time, not not looking at the universe of stocks from 1990 that are in existence today and pulling that data. So yes, we're looking at exact point in time. So the data that was as reported as of whatever period we were looking at, as well as the universe of stocks that existed at that point in time.
And just for clarification on this slide, the terms here. So a member has a question on the term multiple. So when we're talking about multiple, what is a multiple here?
So a multiple is a price multiple. So that could be the price earnings ratio, price to book, price to sales, etc. So it's the valuations that we were talking about as far as what are the risks of investing. Oftentimes with growth investing, is they tend to be high multiple or high valuation companies.
That makes sense. So, and normally speaking, then a stock can trade with the higher multiple if expectations are higher, and also if the ability for that company to achieve that actual growth is higher as well. So it's a simple term for that X thing. It could be a book value, it could be the price times the value of the assets, it could be the price times cash flow, or of course, just to confuse people, the dividend yield, which is sort of the opposite. It's
the inverse.
Thank you. That's pretty much all the questions. I think we've been able to handle most of the questions during the course of the presentation here. I guess just one more question as a follow-up on that. The margin then is simply what percentage of sales gets translated into bottom line earnings or cash flow and whatnot. So margin is the ability to stay profitable.
Yes,
so,
you are correct.
Okay, I guess I did toss one more question at you. Sorry there, Wayne.
No worries.
But so if someone wants to stay up to date as far as what you're doing with the growth investing product, what's the best way to do so?
So if you go to, we've created a sort of a microsite or a blog that has been sort of teasing the AAII growth investing strategy, and that's at www.growthinvestingblog.com. So you can go there, but then also, as attendees today's webinar, you definitely want to be checking your email because all live attendees for today's webinar will also get exclusive pre-release access. Again, hopefully our target date, launch date is October 26th. So that's how you can sort of stay abreast of what's going on with growth investing.
Thank you, Wayne.
Thank you, John.
And
thank you, Jenna.
Back to you.
Thank you. No, that was a fantastic presentation. Thank you so much for guiding us through the world of secular growth investing and giving us a little bit of a taste of what our new subscription is, all about. So I really enjoyed hearing from both of you. Thank you. And
let me just interject very quickly. Jenna was probably unwittingly thrust into the role of project manager a couple of months ago, and she has done an admirable job herding the cats and keeping this moving forward. So, Jenna, I just want to personally thank you for all of the I'm sure frustration that you've dealt with, but also of your hard work as well. So, thank you very much.
Oh, thank you, Wade. It means a lot, and honestly, it's been a passion project from the beginning. So I just love seeing the progression and the process that we've all gone through. It's exciting that it's coming up so soon. So I'm looking forward to the next couple of weeks.
Careful what you wish for.
I know. Exactly. Well, before we go, I do want to highlight an event that we have coming up next week. We have the Individual Investor Show, How to Financially Prepare for the Unexpected, that will debut on Spotify, Apple Podcasts, and YouTube. And that'll be a Thursday, October 27th at 4:30 p.m. Central. And of course, I just want to remind our viewers that, to catch the newest releases of the Individual Investor Show and get notified as soon as we go live, subscribe to us on YouTube as well as any of our favorite podcast platforms. And also, you can check out AAII.com/webinars for more information about all of our upcoming events. We'll be hosting a few more live events within the next few months, actually. So check back from time to time to see what we have in store. We have some more, especially on growth investing, as soon as our product gets launched. And just to mention again, this presentation is recorded, and a replay of the webinar will be available tomorrow on AAII's YouTube channel, along with links to this presentation's handouts, as well as all of the resources that we discussed tonight. And also it'll be on AAII.com/webinars as well, if that's an easier way for you guys to, get to the webinars and all the presentation handouts and everything. So yeah, with that, I just want to wish all of you viewing good health, good fortune, and a great evening. So thank you and take care.
Thank you. Good night, everybody.
Everyone.